Welcome, everybody. It's great to be with you today. My name is Natalie, and I'm a consultant in the Knowledge and Learning team at A4S. In today's session, we'll be examining the emerging trends within sustainable debt finance markets, the challenges in reporting and measuring on impact, and the role treasurers can play. I'm delighted to be joined by Ulf Erlandsson from Anthropocene Fixed Income Institute, Roisin Booth from NatWest Group, and Alex Ashby from WPP, who will be sharing their insights and experiences. Please note that we are recording the webinar for others, and it will be made available on the A4S YouTube channel and website later this month. There are 3 learning objectives from this webinar. After completing today's event, you will be able to, firstly, understand the sustainable debt finance landscape, including emerging trends and leading market practices. Secondly, recognise the tangible benefits of implementing a sustainable finance framework, from enhancing risk management to fostering stakeholder trust and resilience. And finally, translate the practical examples and insights from our speakers to your own work on sustainable debt finance. Please also note that throughout the session, we'll be running a few poll questions, which you will need to complete in order to gain CPE points. The webinar will last around 1 hour, and we're going to have a short intro, followed by a more detailed overview of the market developments from Ulf. And following this, we'll head into some discussion with Roisin and Alex about their practical insights and experiences. There'll be some time for Q&A at the end, so please do drop your questions in the Q&A function and we'll do our best to answer them. By way of brief introduction to the session, sustainable finance is looking at the integration of environmental, social and governance considerations into investment and lending decisions. This includes considering specific environmental and/or social impacts when issuing and using debt. The sustainable debt finance market is key in helping organisations access finance and deliver on their sustainability targets. A significant portion of the sustainable finance market is the sustainable bonds, which have shown significant growth over the last decade. According to the Climate Bonds Initiative, cumulative market issuance of green, social, sustainability and sustainability-linked bonds was 1.5 trillion as at the end of June 2024. Through other sustainable finance debt options such as green, social, sustainability and sustainability-linked loans and sustainability-linked supply chain finance, and these also play a key role. Increasing issuance and growth within sustainable finance markets has been coupled with increased regulation and disclosure requirements globally. For example, in the UK, we've got the Sustainability Disclosure Requirements, SDR, and in the EU, there's the Sustainable Finance Disclosure Regulation, or SFDR, which aim to enhance transparency and reduce greenwashing via entity and product level disclosures. So I'll now do a quick introduction of the guests that we've got today on the webinar. We've got Ulf, Roisin, and Alex. So Ulf is the CEO and founder of Anthropocene Fixed Income Institute, which is a research organisation that takes a market-based approach to delivering positive climate and biodiversity impact through fixed income markets. Prior to this, Ulf gained experience managing corporate credit and portfolios at AFII, a Swedish state pension fund, and has co-authored 3 books on macro and technical credit trading whilst working as a quantitative strategist at Barclays Capital. It's also good to be joined by Roisin, who is head of sustainability reporting at NatWest Group and is responsible for oversight of NatWest's corporate sustainability reporting. Roisin has held a number of prior roles at NatWest Group, including climate reporting and controls lead and group financial planning and analysis manager. Roisin is also part of the 2023-24 A4S Academy cohort, where she is focused on improving the green, social and sustainability bond reporting processes and outputs. And finally, Alex is the Group Treasurer at WPP, heading up the Global Treasury team, Prior to this, Alex was Deputy Treasurer at Tesco, gaining experience with a variety of Treasury and finance roles. Alex was also one of the first A4S Academy participants in the 2021 cohort and won the Innovation Award for efforts in developing sustainability-linked supply chain finance to incentivise Tesco's suppliers to report on greenhouse gas emissions and align with Tesco's climate targets. So a warm welcome to you all. I'll now hand over to Ulf, who will provide an overview of the market. So over to you, Ulf.
Thank you very much, Natalie, and it's very nice to have the opportunity to speak here. So I'll spend the next 15 minutes or so going through some of the main points on sustainability and action and debt finance that we take it. There is a presumption here that you have some prior knowledge on green bonds and some of these instruments. So some of the initials we are going to skip over, and I think just discuss more of the important salient features of the different types of instruments and where the action we think might be happening and give some recommendations on the back of that. I represent something called the Anthropocene Fixed Income Institute. We are a philanthropically funded non-profit organization. We're looking to empower the fixed income markets to drive the climate transition at speed and scale. Essentially, we think of a hypothesis or theory of change where more money is moved towards the more sustainable solutions in markets and less money go towards those that are actually not aligned with the climate transition. And as illustrated in this little graph, by doing so, if eventually you affect cost of capital by the supply and demand curves of capital, and that eventually also leads down to investment projects in the real economy reaching or not reaching their intended internal rates of return, which means that they will happen or not happen. So by shifting the capital, we hope to have these sort of real effect returns. What we do slightly differently at AFII is that we take a very much market-focused approach to this. So we think that in order to be convincing when it comes to investors, which is our main stakeholder, we need to speak their language. We need to frame this in a market-focused, actionable fixed income type of language. We're based in both London and Stockholm. I'm calling today out of Stockholm. Most of my team sits in London, actually, so feel free to reach out for us and meet us in the city at some point if you want to. So, setting the scene to begin with. Well, first of all, there is a very important distinction when we're talking about debt markets and sustainability in terms of what we call use of proceeds versus general corporate purpose and performance-linked type of instruments. Now, the normal case is what we have, and the almost dominant sort of type of debt instrument out there is the green bond. The green bond is a use of proceeds bonds, and you will find social bonds and similar types of bonds traditionally being use of proceeds, which essentially means that there is a soft commitment, not legally enforceable, but still mentioned in prospectuses and so on, that the issuer will deploy the money they raised through the bond transaction via or into a specific set of projects or operations. So it's sort of asset-backed light in one ways. Now, that has been a very good format for certain purposes. It might be a less good format for other purposes. For example, there's been a huge discussion around the notion of transition bonds, in which you're more looking towards use of proceeds, but for something to change over time. So far, the transition bond market has been quite unpopular, I would say, or not that very much of issuance in there. Notably here, if we're looking at what's happening in the markets right now, there's been a pretty substantial transition bond issuance program from Japan, which is where I borrowed this chart as well, in terms of looking at doing the use of proceeds format, but towards transition rather than outright green bond. Now, on the other side, we have what's called performance linked, which would be the sustainability linked bonds and similar, where it's a general corporate purpose bond. So there is no ring fencing or soft ring fencing of assets, but there is some sort of outcome target. And I'll speak more about those in a little bit. One thing I want to start off with when we're talking about predominantly the use of proceeds format is the discussion around additionality. So you will find any green bond discussion saying now, is there additionality? Is there actually something happening that wouldn't be happening unless the green bond was issued? Well, you can argue this from different ways. You can say that bond finance has the opportunity for considerable additionality, like in M&A transaction and in things like that, where companies are quite dependent on being able to raise bond finance. But most of the time, bond finance is actually pretty boring. It is refinancing of old bonds that roll off the curve. It's replacing old capital. It's being the end of the road cheapest financing for a lot of projects, which suggests little additionality. And I think that's okay. We've written some around it and saying that a bond, even if it's a green bond, is also not where you expect development capital or really additional capital. It is something which is important, but it's not going to change the world in itself. Now, and I'm not going to go into all of these slides in much detail, but you can discuss the cost, the impact in terms of cost of capital differentiation. And when it comes to the use of proceeds bonds, the green bonds, the difference in cost of capital for the issuer is roughly between 0 to a few basis points in general. And even a pretty extreme study like this one I'm referencing here are coming up to numbers that aren't changing the world. And if we go back to other argument, that's not so different. And if you look at it from an investor's perspective, well, when you're buying a green bond, you're buying something which is pari passu, which is equal in ranking to any other debt instrument. So at crunch time, at the point of default, and go and look at your Thames water bonds, for example, you will be pricing your green bonds similarly to every other bond in the capital structure because they don't have any additional protection, which motivates why there shouldn't be much of what we call a greenium. One interesting discussion, I think, and this is one where there isn't a set agenda from investor side, but it is how do we account for carbon footprint when it comes to green bonds? Because if I buy a green bond for a company, I probably want it to look better than a traditional bond. And how you do that and how you prorate that is a thing that you can discuss at some length. And different investors have different answers, and there isn't no standard on this. And many investors in passive investment vehicles, they don't do any discounting in terms of green bonds. So this is something where we think that the accounting profession and the sustainability profession need to come together and really think hard about what should be the right way to do this. Because if you start discounting for green bonds, then you should also increase the carbon footprint from other debt instruments in the capital structure. Another thing that's often talked about greeniums, and the difference here is with regards to how much these price and difference between traditional bonds and green bonds. And that is time varying. It's not a given thing, and it goes up and it goes down. Right now, there are some examples where this is pretty much close to 0, even for almost identical green and traditional bonds on sovereign bond curves. An important dimension of this discussion is always, are these guardrails against greenwashing? And just shortly saying that, green bonds rely upon the fact that if there is greenwashing in a green bond, well, it will be hard to come back to the market and issue another green bond. That's a bit different from sustainability-linked bonds, where there can be a differentiation in terms of performance instead. We'll come back to that, but there are important points of the green bond or the sustainability GSSS bonds, investors looking after companies to actually follow up on their sustainability promises. And there are quite a lot of interesting things you can study here. If you want to have a case study on something where someone did both sustainability-linked bond and green bonds in the same bond issuance, there was an interesting deal from AFII earlier this year, which you can see referenced in our research. So SLBs, sustainability-linked bonds. A little bit of a deep dive here, but we wrote a book in May, Sustainability-Linked Bond Handbook. You can get the link in the chat and through here and download it for free. Essentially, we're going through 40, 50 case studies of various sustainability-linked bonds, what we think is good and what we think is not so good. But at the core of what we're thinking and why we think this is a compelling instrument, especially when it comes to transition, is the basic fact that you're looking at the structure where there is an incentive or a disincentive in terms of performing or not performing vis-a-vis your sustainability targets. And we think that is actually quite a good thing. Now, there is a lot of maths here, but what you should think about when you think about sustainability-linked bond, and we're going to think about one which is a step up, is that if you look at the bond and there is a step up in the future and there might be, you know, cash flows that are valued today on a discounted basis to be worth $1. Well, how much should you as an investor today invest in that bond where you have a potential of having a step up worth $1? Well, that all depends about the probability of that step up happening. And that step up happening is when the company is not reaching their sustainability performance target. So when you boil this down, at the core of all of these equations and all the analysis you can do, SLBs are really around probabilities to achieve or not achieve sustainability performance targets. Everything else you can sort of parameterize, but it is very centered on this probability. And I think that's a very refreshing perspective to have on an asset and sustainability investment analysis. So we can go into a lot of calibrations and discussions around how these things work. There are some examples about where these actually work the way it's supposed to, but there are also lots of examples in terms of SLB not working as well as we would like to. There's been a very substantial slowdown in SLB structures of 2024. Having said that, it's pretty chunky still. It's around 400 billion of SLBs outstanding. And if you compare that with other performance-linked bonds, it's actually quite a substantial part of that performance-linked market, but of course, much smaller than green bonds. We think there are a number of reasons behind this low issuance, but we think there is a substantial potential for the market to rejig around this. When we're looking at anything, when it comes to recommendations in this very flexible instrument, it is be transparent and have pretty parsimonious or simple structures, maybe one KPI even. Now, the reason for that is it's impossible to price these things if you have too many KPIs. And if you can't price them, then you can't get any sort of benefit in terms of lower cost of capital when you're issuing and when you're actually performing across the targets. It also solves a lot of other issues around data provisioning and other things that are sitting in there. So I'm going to wrap up here because this is my allotted time. But there are quite a substantial flexibility and potentials, we think, in the SLB type of issuance. But pressing across this, and there's a fantastic column in Responsible Investor today, the cost of capital argument should be the strongest point even. If you're successful on your sustainability journey, you should achieve a lower cost of capital. And mathematically speaking, the SLBs can actually provide you with that. So I'll stop there and we will take questions at the end, I believe, if people wish.
Perfect. Thank you. No, that's really, really helpful. I think people to bear in mind when using these products. So thank you for sharing. Great. So we'll now hear from Roisin, who will be providing practical insights from NatWest's Sustainable Finance Framework and Issuances, and talking about how tracking and reporting impact has helped build trust with investors. So welcome, Roisin.
Hi, Natalie.
So just to kick us off, first question is, please could you provide just a little bit of background on NatWest's Green, Social and Sustainability Financing Framework and how eligible green and social asset categories were selected? If you could just outline the financial instruments that have been issued using the framework and just some of the benefits of developing the framework.
Yeah, sure. So I guess first of all, I'll just clarify, I guess today I'm talking about our GSS financing framework. So our own issuances as a company, our own funding. So obviously as a bank, we also kind of underwrite, facilitate for our customers as well in a different arm. So this is purely about our own sort of funding plan and how GSS fits into that. So I guess we developed our GSS financing framework a number of years ago and have iterated it as we've kind of tested and learned things in the market, with the aim of attracting dedicated and diversified funding for loans and investments that we think are likely to deliver either positive environmental or social impacts, as well as to help create long-term value for our shareholders. There are 4 key components of our framework in line with the ICMA, so International Capital Markets Association guidance. So we look at the use of proceeds, the evaluation and selection criteria, which I think you just mentioned, Natalie, the management of these proceeds and the reporting. So reporting is where myself and my team mostly come in, and that's where most of my focus of the conversation today will be. But it's just important to understand the components of our framework. And really, the framework is a really, really important tool that makes sure, helps to provide that very clear and transparent set of guidelines and criteria and definitions to ensure that our bond issuances, ongoing tracking, monitoring, and our calculations are aligned with the principles set out by the ICMA Green, Social and Sustainability Best Practice Guidance. So it's really just that sort of manuscript essentially to guide us and make sure that our activities are really having the intended impact as we move through. So up to the end of last year, we had issued 3 green and 3 social bonds. We haven't made our way into the sustainability bond market yet. It was very interesting hearing the outline there from Ulf. And as at the end of last year, those bonds had a combined notional at issuance of around £4 billion. So these bonds, they cover eligible asset categories such as green buildings, renewable energy, affordable housing, job creation, and also women-led businesses. And again, these are in line with key components kind of around the ICMA guidance that we see. So we're really just trying to follow the guidance and make sure that we're kind of contributing towards categories that we think are going to support that as the intended impact that we're looking for, but also that align with our strategy and our focus as a business too. One last thing, so this year we've continued our activity with bond issuances. So we became the first UK bank earlier this year to issue a bond dedicated to financing and refinancing electric vehicles with our €750 million EV bond. So I think to summarize the point, our framework is kind of that guidance document. It keeps us right. It gives us kind of the framework to work within. And then we continue to seek out kind of innovative options to try to ensure that we're providing, I guess, useful facilities for our investors and others to kind of get behind and support our strategy, Natalie. Hopefully that answers the question.
That's helpful, thank you. And it's good to bring out the ICMA principles because I know they are kind of widely used across the market and a really useful reference point for people just starting out to bring that kind of transparency and consistency. So Roisin, now to talk a little bit about kind of your work when you've been part of the A4S Academy. So you've been working on kind of improving awareness and technical knowledge of GSS bond and reporting and issuance across NatWest. So you could just share some of the insights from this work, kind of looking at where you started and things that were most helpful to you.
Absolutely. So I suppose, again, just to reiterate, again, stealing from my previous presenter here, my team are probably more your accountants in this role. So it kind of shows how, I guess, the main goal of my project, I suppose, was to try and ensure that the accountants and the treasury team could kind of learn from one another, work together and really enhance each other's understanding of what we were trying to do here. With the reporting, really get that discipline in place that we would have with our kind of financial reporting that we see, but learn from our more established sustainability reporting processes that we have on our outputs from NatWest, which receive really good feedback. So particularly pointing to our climate related disclosures report. So we sort of set about a multi-pronged project really as a team. I would say it wasn't just my project. It was, you know, firstly, we really wanted to improve the quality of our disclosure. So you can be doing the most innovative, exciting sort of bond issuances and tracking, monitoring, you know, a multitude of KPIs, if that's what you think the right thing is. But if you're not clearly communicating this in a transparent and effective manner, it's not really worth as much as you might think it is my perspective anyway. So we really focused in on honing in the really important bits and the key differentiation points of our, I guess, issuance progress to date, and our ongoing approach about how we see our GSS within our funding plan and also our sustainability strategy, and tried to make sure that we were able to really get that detail out, fully understand it across the extended team that works on this, and make sure that came across in our disclosures. As part of that, we realized that there were roles for different parties within this. The accountants, so my team, let's just call us that, we needed to better understand this. You cannot do a good report unless you understand the substance that you're writing about and you're producing content on. So we really focused on upskilling ourselves with the Treasury team. It was reciprocal because we also were able to help upskill and educate the Treasury team in terms of how we can have a really effective reporting discipline, how we can really equip investor relations with the information they really need. So that was kind of the focus, and also making sure that we did kind of mature the process by looking at our peers in terms of the outputs. Who does things in a really classy way? Who can we learn from in a very effective disclosure? What's the best that we already do? Let's bring that into this report. And also in this behind the scenes, trying to make sure that we're embedding process efficiency as well and control efficiency so that the report is as robust as it possibly can be, whilst it's a developing area. So I would happy to say, you know, we've made massive strides this year. So thanks A4S for encouraging the implementation plan on this topic. And we've been met with our most recent report, which was published in April 2024. We've been met with really positive investor feedback, as well as other external and internal feedback in terms of progress that we've made in this space. So the underscore of it was kind of collaboration, communication, and really understanding the role each party had to play in enhancing the overall approach. And the other benefit I would say from that is that we've probably then, the finance team, non-treasury finance, we've probably started to kind of show our worth a little bit more in this space. So we've started to be involved at an earlier stage. We're not just seen as the reporting people. We get involved kind of at the issuance process and understanding the data that's available, et cetera. So we're now getting brought in at a much earlier stage and have more of an ability to influence, you know, things that will eventually be part of our reporting suite. So it's really good. It's been a success.
That's brilliant, and great to hear about the kind of very practical action that members of the finance team can take in this field. And interested to hear you talk about working with the Treasury Department, because I think that's something we'll come on to when we speak to Alex, who plays a role within Treasury. So yeah, thank you. And then Roisin, just talk a little bit more about kind of reporting, but also tracking, you know, around the impact of some of the bonds that have been issued. If you could just kind of talk us through some of the challenges that you've been faced, looking at measuring reporting impact and how you've kind of overcome these challenges.
So I don't think it'll surprise anyone, but loans are not written with GSS impact reporting in mind. They are written in line with the risk parameters and strategic parameters and sector strategies, for example, sector and portfolio strategies that exist across the business. So particularly if you're sort of working on a particularly novel bond that may have, you know, a slightly novel measurement KPI or impact measurement, let's say, you're kind of creating a bit of a challenge for different parties in the group to find out what data is available, you know, how robust is it? Is it complete? Is it assurable? What methodologies do we see in the market? If it's really innovative, you might not have anyone else in the market doing anything similar. So That's one of the key challenges, I guess, just the data that exists, because you're drawing upon information that is not intended for impact reporting purposes yet anyway. That said, the way we've tried to overcome this is where there are existing processes in place, like, for example, our financed emissions models that we have in place for calculating financed emissions on our lending book. It's trying to think up front, okay, well, how can we use the work that's already in place for that and try to align, meaningful measurement impact criteria to be fed by a mechanism or a calculation methodology or an impact, essentially an impact methodology in a different form. How can we use that to inform this new bond, for example? And that doesn't always have to be in the climate sustainable social space. We also kind of look at our existing, this is again where accountants probably can come in. We kind of look at our existing IFRS 9 processes, our sector levels reporting, that there's a wealth of data that exists, and particularly in regulatory reporting spaces, that often is overlooked, and it can be a really helpful way, if you can interpret it properly, a really helpful way to then think about how you can use data in clever ways to service another reporting need. And you're able to kind of rely upon it a little bit more as well, because it's obviously already going through the financial checks and balances, and in some cases audited rather than just assured. So data is probably the key one. I guess the other one is it's novel, and people are interested in novel things, but capacity is always a challenge. So this can take a little bit of time to get people's heads around. But I think what we found is we try and dip this topic into kind of finance offsites and finance team meetings and things, that people are always engaged with it really, really well. I think it brings sustainability home to an accountant that likes numbers, because they go, oh, I can get that I can get my head around. So but it's the capacity of then taking that step further, but that's a different point completely. But I hope that helps.
Yeah, that's helpful. And I think it's that kind of processes, like you say, of looking, how can we draw on existing processes to get the information we need on impact, recognizing that measuring impact is difficult. There's data availability challenges, there's timing challenges, there's proving additionality, there's a whole bucket of things to have to deal with when looking at impact. But I think having those processes in place is really, really positive.
Or the principles, you may not always have a process to rely upon, but if you have principles that you've used before, then you can try and roll it out at pace, because obviously this often happens at pace as well. You identify a set of assets and you've got to move because it's a good time to issue. So it's an interesting balance between, interesting to hear what Alex has to say around that in his section, because there's only so much time, otherwise you run out of time. And an accountant, we love to work on things till it's perfect, but
and it's not always black and white in this case, is it? But, speaking about it, so I'm very aware of time, but Roisin, just quickly one final question, and then we'll come on to Alex. So talking about those processes, could you just briefly kind of talk us through that process of how you measure impact for some of those bonds, and what kind of metrics you're using, and methodology to do that?
So I would say that some of these methodologies are they would be very difficult to follow if I were to verbalize them. So definitely do a plug and encourage you to have a look at our last GSS impact report, allocation impact report. We did spend a lot of time making sure that they were very transparently outlined. So please do have a look at those. But I will kind of just give an example of one of the more simple ones to outline. So one of our green bonds focuses on green buildings, specifically on green mortgages. And essentially the key metric is estimated carbon emissions avoided. So the simple calculation is essentially you have the benchmark, which is the emissions intensity from NatWest Group's residential mortgages portfolio. And that's calculated through our financed emissions model. This is what I was talking about earlier. And then, because the financed emissions model, a key input is floor space. So for the same floor space, we know that houses with an EPC, so an energy performance certificate rating of A or B, have around a 60% less carbon intensity than our general book, our mortgage book. So we then perform a separate calculation, which shows using the same square footage, but the lower carbon intensity just for the green mortgage portfolio. And then the delta between the two is the estimated carbon emissions avoided, but you only apply that to the mortgages included within scope of this bond. So you then get essentially a proxy of the estimated emissions avoided. So that's probably the simplest one to outline. But essentially, it's just trying to show, you know, if we were to continue funding mortgages of A and B over time, you would obviously start to see the emissions intensity of our book reduce, you know, essentially. So that's kind of a key crux of this. So yeah, that's probably a quick run through. But happy to pause there, Natalie.
Brilliant. Thanks, Roisin. And we'll share a link to some of the resources from NatWest. So if people are interested, they can explore those further. So thank you. We'll now move on to discussion with Alex, who will be giving us some insights into what debt finance means for treasurers. So welcome, Alex. So just to kick us off, if you could just talk us through your experience as a treasurer working on sustainable debt finance, please.
Sure, Natalie, thanks. Great to be here. I guess I'll go a bit broader than our other speakers. I mean, I think for me, it all started, a great example is our 2020 RCF revolving credit facility at Tesco. It was very much a kind of, you know, early adoption of, you know, a variety of the similar principles with an impact on fees from some core KPIs, greenhouse gas emissions, renewable energy, food waste, and very much we had the belief then that we want to keep things as simple as possible. It's great hearing Roisin talk about the finance teams. We actually talked to them up front, believe it or not, and as well as the sustainability teams, we really had a collaboration of, right, what do we do? What do we already report? What do we intend to report? And what's already assured or not? So we can try and keep things as simple as possible. So the idea was the RCF would be that template. So we can go, right, here are 3 core KPIs, maybe add some more on if we wanted to, and have that. And that links to then developing a sustainability linked financing framework, which then led to some nice sustainability linked bonds, which we then did a little bit afterwards. We did in Jan 21, we did a €750, which is fantastic, and it was UK first, and then it followed it up quite quickly later that year with a sterling equivalent. So both linked to greenhouse gas emission reductions, scope 1 and 2, so which is fantastic. Although I would say that, you know, if we were looking at that at WPP now, I mean, if we tried to do something similar and just restricted to scope 1 and 2, where businesses have a low scope 3, they probably would struggle to be credible in the current market, and we'd be worried about that. I mean, we did think about it. The problem is scope 3 is such a hard area. This is your supply chain's emissions to try and estimate. And it's great hearing from Roisin and others about calculators. We've developed a media calculator at WPP for our clients, others to use, but it's very nascent, you know, it's very new. So really trying to develop and get more robustness there. And you know, we didn't just not look at it though. We did look at scope 3, and again, another Tesco example, we very much decided to go, right, okay, well, what can we do that's most impactful here? And we actually looked at the supply chain and developed a market-leading supply chain finance, which I did as my project for the AFII Academy, which is fantastic. Ended up looking at, I think at the time it was about £2 to £3 billion per annum of financing, and it was a, you know, really nice facility in terms of linking to what suppliers did, what they achieved. We had a very simple questionnaire for them, and we even tailored that questionnaire so SMEs would be asked less detail than larger caps that have teams doing this. Often an SME, when you're working in food retail, could be the CFO, the FD, or a team of 2. You know, you need to be mindful of that. So we really tried to kind of think about it from the supplier perspective and go, right, do you want to be part of this? Came up with some tiers. There was favourable pricing if you're in the gold tier, silver tier, etc., which was really well received. I think really well received, and we actually did, despite the fact it's not required, wrap assurance around that just to give suppliers the confidence, which is more around how we were doing the scoring, which we got independently verified. So people felt there was no, you know, unfairness in there if they were you know, moved up or down. So, you know, it really was a great partnership, you know, with the finance sustainability teams, and you know, very much one of the few, and my sustainability team saying it was one of the few carrots they had at the time that we could offer out to suppliers. There's a lot of asks, more data, this, that, set targets, etc. at that time, and it was fantastic to be able to say, well, actually, we can offer you some reduced cost financing if you want to come and be part of this optional facility. So, you know, really great. It wasn't a world first, unfortunately. Walmart got there first, but it was a great extension of that to the UK markets, and again supported by NatWest, who were very helpful, as well as the other banks that we had in the bank group.
Brilliant, and good to hear that kind of direct experience of supply chain financing, because I think it's a really good way to enable engagement with organisations and their supply chain, because as you say, Scope 3 can be a real challenge. So I think a really good mechanism in which to do that. And just kind of drawing on your experience, Alex, because you've held a few different roles within Treasury. Do you know, how do you see the role of treasurers within sustainable debt finance, and how this has kind of evolved with the growth of the market, and how it's kind of changed over time?
Yeah, that's a great question. I mean, look, the core purpose of Treasury is to be the kind of the guardian of cash, right money, right place, right time, and enough of it, I guess, to make sure businesses are supported and they have enough to do what they need. And if there is a black swan event, to keep things afloat, which we've seen with COVID and other recent events. So that really is the core of what it is. But I mean, fundamentally for me, I've really believed in this partnership. One of the first person I reached out to was Hannah at WP Build. I joined to go and have a chat with our Chief Sustainability Officer to see what they're doing, how we can partner, to show that excitement. And I've really kind of become the kind of lead person in finance for that. Really, I mean, it really is about bridging. It was great hearing Roisin talk about it. Trying to bridge different teams with different expertise and lingo together to try and bring something that's actually quite hard to land sometimes. These conversations are quite technical. We're technical from a financing perspective, technical from a sustainability perspective, and potentially technical from a reporting and assurance perspective. So, it's definitely not easy for boards, CFOs, audit committees to understand this. So for me, it's very much being that kind of helping to be that conduit and helping to really promote things and really think about it from the perspective of others, board members that may not have this understanding. I had great success looking at this, and there's a lot more wider applications of debt than doing sustainability-linked bonds. I know that's the focus, but I very much I cover supply chain finance. I've been involved in pension boards with investment strategy at the same, in a similar vein in terms of what one should invest and how, and the regulation around that. And similarly, I've also looked at the debt and the structuring behind new wind and solar farms, which I did at Tesco, which was fantastic. So I do think there's a lot of broad applications. It's not as simple as let's do a bond, sort out the reporting. For me, I very much try and think about that broader application and really think, where can you add value, but really balancing the kind of the risk reward, but also the kind of, that kind of progressiveness that one needs to have in this current climate. We need to take a little bit of risk, otherwise no one's going to achieve anything. But it's very much a team game. As I said, I mean, everything I've talked about is never been me. There's always been a strong team behind it, be it Treasury, finance, sustainability, and many others, procurement, etc.
It's actually that kind of collaborative effort, isn't it? Actually using this kind of range of initiatives to raise awareness and drive action within an organisation, because as you say, it needs different input from different teams. So thank you. And Alex, another one, like, what are kind of the key challenges that you're seeing both within the wider market and kind of specifically within your industry? Yeah,
sure. I mean, I think I touched on it earlier. I mean, there's a real, and this may be why I think I also touched on earlier, there's been 400 billion of issuance. I remember back when we did those bonds at Tesco, everyone had a chart hitting $1 trillion in the next 3 or 4 years at that time, and it's very much come off a bit. And I think a lot of that now has been this kind of risk-based approach, but by a lot of third parties, people willing to put their name to it, greenwashing headlines, etc. A lot of the environmental stuff has to include Scope 3. That's generally what I'm told by people in terms of what's credible, what can you put out there. If you went out with a Scope 1 and 2 bond and it's less than 5% of your emissions, I can understand why someone's going to challenge that. The problem you've got is Scope 3, the supply chain emissions that we have. They're incredibly hard to calculate. We heard from NatWest have got a finance calculator. I mentioned we've got a media calculator, but it's not as simple as that. It's like there are so many thousands of variables that go into it, and fundamentally, when it's so disparate, it's again very hard to be able to provide assurance and confidence, or even stability. Debt instruments like bonds are obviously multi-year in their duration. Minimum 5 years, maybe 3. If not 8, 10, or longer. You're very much stuck with this calculation for better or for worse when you put it out there. So you've got to be really, really careful with what one does and how you do it. So I do believe that's my take on why there's been a bit of a pullback. We're kind of waiting for CSRD, TCFD. It's coming. There's going to be a lot more robustness coming through the numbers, the reporting, the disclosure. But I think we've had a bit of a kind of hiatus where everyone's very much focused on that disclosure reporting. And then look, once we get there and we've got all these fantastic KPIs from those that report under CSRD, etc., the European directive, then there's going to be a whole new load of opportunities to go forward and look at from a debt perspective. But I mean, it's not just environment. I mean, on the social side, again, there are issues there. I mean, we very much, I've worked for lots of big employers, 100,000 people at WPP, you know, 350,000 at Tesco, and the social side is paramount. But there are very few KPIs other than gender balance that one can really try and do. And if you've overachieved on that, which we have at WPP, you start struggling to see what else there is possible. And there are limitations where you've got legal restrictions like in France and the markets on what data you can capture of your employees. So that, you know, there are, you know, quite a few things that I hope get moving, if that makes sense, to come together so people can do what they want to do in this space.
Absolutely. And I think on that as well, you kind of touched about the progress that's been made and referenced some kind of disclosure standards and movements that have been made to kind of improve some of the challenges. Are there any other kind of big areas of progress and things that you think have been really instrumental in moving the market forward?
You know what, I think there's a lot of narrative about that. I mean, one of the benefits, I'm going off topic slightly, of working for we're not really a media company, people are a creative company. We've done some fantastic things. Some of what some of the brands are doing out there is absolutely incredible. You know, I'll give you a couple of quick examples. I mean, we did a thing in China with Corona, the beer brand, but obviously struggling a little bit after the 2020 pandemic with their brand, etc. And one of the issues they had in China was that you can't get good limes, and everyone has a Corona with a lime, you know, those that do anyway. So we actually worked with government, local industry, and Corona InBev to go and actually, you know, to get local wines grown for that, and they did a big promotion, fair wages for farmers, and really had a whole end-to-end sort of product with it, which ended up with a lift in sales for them, but also a really, really nice narrative and one would argue a sustainable future for lime growth, rather than having bad ones locally and a bad taste, or importing them, you know, having them locally grown by farmers for fair wages. So that there's some great examples out there. I won't get into too many, but you know, I think for me it's about that innovation piece. I think there's so much opportunity. You know, it reminds me, one of the conversations I had at Tesco, I remember someone coming to me going, "Alex, we want to look at soy farmers." I was like, "Right, okay." In Brazil, I was like, "Okay, great. That's an easy market to work in. That's a, you know, lovely market, but hard to work in financially. And we want to do some. We want to lend them money." And I'm like, "Right, okay, this sounds terrible." But it ended up leading to a fantastic product, which I think got Green Bog of the Year last year, for where we had satellite monitored, conservation based, you know, lending from most of the major supermarkets in the UK to soy farmers, which is where a lot of the animal feed produce comes from. So it's really trying to look down the supply chain and see what one can do and how one can innovate. And the idea of that product was not just lend some money. It wasn't a huge sum. I think it was 20 to 30 million to start with. They've done a second round this year of 100 million. The idea is to try and get it to a material part of the local financing out there, if that makes sense, with obviously certain stipulations overseen by a panel of NGOs in terms of what good behaviour looks like, you know, no deforestation, conservation, and so on. So anyway, I'm still slightly waiting for my wonderful innovative idea to BPP, but very much holding out and trying to see what we can do and what's possible within the market without just being constrained to simple products that are already out there.
Yeah, absolutely. I think that kind of innovation point is key. And I actually think it's quite exciting to see, you know, how entities are innovating in this space and doing things creatively and using finance as a tool to address some of the sustainability challenges that are out there. So yeah, it's interesting to see. Perfect. Thank you, Alex. So now we've got a short time of Q&A. So it's not too late. If you have any questions, please do post them in the chat function. You can see them there. So there's a question. We'll ask just to each of our panelists what their kind of top tips would be. You know, we've talked of kind of different areas of sustainable finance and what top tips you would have to others who are working in the space and progressing things. So be it around linked bonds, treasury, frameworks, and you can pick. But Ulf, do you want to kick us off?
Well, yeah, something we often say when we speak to issuers of or potential, you know, issuers of these types of bonds is that you should be a little bit well, careful in terms of the investor base when you're having, you know, investor discussions and so on, because there will be a fairly loud voice of very orthodox type of green investors who are running Article 9 only funds, and they are, you know, wanting to prove their greenness, and that is their competitive advantage. And they might sometimes be asking, you know, too much and too onerous things from the issuers. And I just want to, you know, say to people that, you know, you should try to also meet mainstream investors who are more understanding of transition, of the difficulties that both other speakers are talking about here, and get that feedback as well, so you don't go and just meet a couple of the very hardcore enthusiasts and follow the lead on what they do, because then sometimes it becomes quite cumbersome and you have to overdo it essentially. So try to get that balance would be one piece of advice.
Perfect, thank you. Roisin?
I'll probably come from a reporting angle. So quickly, I would probably say assurance, third party, second party assurance in some shape or form of your framework, usually a second party reviewer, of your metrics. Try to get the auditors involved. Their feedback is very, very, very valuable and adds credibility to the reporting. We've definitely found that. I think transparency around limitations, the methodologies that you are using, it gets sort of thanked for, helps people understand per Ulf's point there, the journey that we are on. As long as we keep improving it, we don't just keep making the same excuses, of course. And then I guess finally is try to bring the impact to life for your general purpose users. So that could be case studies, what have you, because you do want more and more people to be opening these documents and understanding what your strategy is. So try and make it accessible where you can.
Thank you. And finally to you, Alex.
Well, just to build on that, I agree with everything said really, but engage your teams as CFO, be open and mindful of the risks and downsides, as well as the positive narrative. All right, you've got to be balanced when you have these things. If you're trying to ignore or hide the fact that there are risks with some of these things, then you're not going to get very far. But I love the point from Roisin about culture, build a platform internally. You know what I mean? Talk to people. I had so many people that were so excited by this. I had somebody who's like, Alex, I don't know anything about this. I don't know any of the jargon. Can I come work on a project with you? I was like, yeah, you're exactly the person we want. He's like, really? I was like, yeah, you're keen. You believe in doing something. Let's go and do it together. Fundamentally, got to take a bit of risk, as I said earlier. Lead from the front, have a go. Don't be afraid for failure, and see what things come back. And no doesn't mean no forever. It can be not now, it can be come back to it later. All this work is great and it needs to be done. We need to really get the focus going. As I said, I think we've lost a few years of progress. Please, everyone, get back on it. The more of us out there doing the right thing, setting the right trends, as I've said, with investors and really pushing boundaries, we'll get a better reception. Okay, it's very easy to have an existing checklist. What's the hardest thing is to really try and create the next one, if that makes sense, or influence it.
Brilliant. I like that call to action as well. So thank you. And thank you to all our speakers. That's been a great session and really insightful. So today we looked at the emerging trends within the sustainable debt finance markets, the challenges in reporting and measuring on impact, and the role that the treasurers can play. If you're interested in finding out more, there's a range of different A4S resources in this area, and we'll share those links in the chat function. So please do explore those and get in touch if you'd like to find out more. So I'd just like to say a big thank you again to the speakers and thank you for listening. For those of you that joined the webinar today, if you haven't already registered, our Enhancing Investor Engagement webinar is taking place on the 28th of November. The link to register is now being shared in the chat. So we look forward to seeing you there if you can join that webinar. And that brings the session to a close. So thank you again to the speakers. Thank you for joining and enjoy the rest of your day, everyone.